Good morning, everybody. We'll wait a minute or two, see if we get a slew of students here to go over what I believe will be chapter 6. Great tell, we have a visitor. Hi, Carrie.
Hi, Bob. How are you?
Good, good. You ready for what I believe is chapter 6, right?
Yes.
Okay, give me a moment to rack that up. Chapter 6. Okay, just having a little trouble digging it up. Hold on.
You know the examples in the beginning of each chapter?
Yes.
Are those real or are those made up?
Oh, no, those anecdotes, you mean?
Yeah.
No, those are real life situations as far as I know.
Oh, cool.
Yeah, that's where they talk a little bit about fraud a couple times. Am I wrong?
Possibly. I don't recall specifically, but just wondered.
Okay, this thing won't cooperate. Come on. Chapter 6. Okay. PowerPoint slides. Ah,
It's like it's advertising these businesses.
oh yeah, oh yeah, Microsoft or Walmart, yeah, they'll buy a couple pages in the book for sure.
Mhm.
Hold on here. Finally, share screen, chapter 6. Okay. Let me set it up. All right. Now we're going to learn about closing entries. Remember, you were asking me the other day when we were going through the 10-column worksheet why we ended up with a debit side on the income statement. Maybe you don't recall that question, but we're going to get to that here. Financial statement in the closing process. Back to our worksheet, okay? We journalize adjusting entries, we prepare the financial statements, and now we have to do, carry what are called closing entries.
Okay.
Closing entries. So we have our regular transactions we do during the month. Then we have the adjusting entries, which can only be done at month end.
Mhm.
And then finally, after we've finished all the financial statements and everything is perfect, we still have to close out the income statement. So let's talk about that. You prepare the financial statements with a worksheet. We know the order of them, huh? Income statement,
Right.
equity, balance sheet. Income statement preparation. And here they're just showing us, as you I don't want to say as you should know, as we all know. As we all know, the income statement begins right here on the trial balance, and you just bring the numbers over
Mhm.
to the income statement, okay? Statement of owner's equity. I guess they're reviewing the financial statements for us, huh? I guess it won't hurt. one paragraph there, instead of showing revenue increasing and expenses decreasing the owner's equity, this statement uses the net effect. In other words, the net income you're bringing
Okay.
over.
Right.
And I think we're good with this one, right, Carrie? This is pretty easy when you
Yes.
do a couple. Have the beginning plus net income minus drawing. You bide your time.
Right.
Different forms of balance sheets. Yeah. Liabilities and owner's equity are shown below the assets section. Assets, they're talking about how to lay out the balance sheet. They're suggesting assets are on the left, liabilities on the right. You can do them on top of each other too. Current assets, plant, property, and equipment. Liabilities are current and long-term. And we've talked about current assets. Current assets, assets that will be turned into cash or consumed within 1 year. Have we talked about current assets at all,
No.
Gary?
No.
Okay, that's good then. Current assets. Current assets are the very liquid ones. Current assets are the ones that are going to be consumed within a year or the operating cycle, whichever is longer. All right.
Mhm.
Current assets. And we do a lot of analysis by looking at the current assets and the current liabilities and comparing them. So current assets, assets that are used up within a year, typically cash, accounts receivable, the supplies, and the prepaid insurance here, okay?
Mhm.
And you could add to that inventory.
Okay.
We'll skip this. The cycle for a service business. We know this. We start with cash. We buy our motor scooters, and then we provide services. We provide services, collect receivables, and the cycle.
That wouldn't, oh, yeah, okay. A service
Yeah.
business, right, okay, got it.
Yeah. Okay, now we have what are called non-current assets, fixed assets. Let's call these fixed assets. Property, plant, and equipment. These are the big ticketed items that you depreciate. Remember the depreciation expense entry we did on Monday?
Yeah.
Or Tuesday rather? These are the things that we're depreciating. These long-term assets, non-current assets. When it comes to plant, property, equipment, we call them fixed assets, okay?
Mhm.
They will not be used up within a year. We're gonna have these for a long time, hopefully.
Right.
Just like current assets are those that are used up within a year,
Uh-huh.
current liabilities are those that will be payable within a year.
Okay.
Current assets, they'll be paid with current liabilities, and they'll be paid with current assets. And the best examples of those are your payables, accounts payable, wages payable, taxes payable. Those would be current liabilities. Long-term liabilities might be a note where you borrowed money or a mortgage. So
Right.
you have current assets, current liabilities. Long-term liabilities, obligations that are not going to be paid within a year. These are things that could go on forever. A mortgage, you buy a house, you're going to be making that payment for the next 30 years.
Mhm.
That's an example of long-term debt. And then they're pointing out Mitch doesn't have any long-term liabilities.
Good for Mitch,
What's that?
good for Mitch.
Yeah, Mitch, but that was some summer job that guy started, right?
Right.
He did better than me working at the stupid department store for like $1 an hour in those days. Anyway, I date myself. Balance sheet preparation. I'm going to skip this. Okay, another one of those drawings where they're bringing things over for us.
So this worksheet, is this the work, when they're referring to worksheet, is that different than the last 10 column worksheet,
No,
right?
no, it's exactly the same thing.
Okay,
Yeah, over on the left, you're looking at columns 9 and 10 of that
got
sheet.
it. Okay.
Yeah. So let me just take a snort here. Jackie Gleason would take a sip, and then you'd hear the sound effect when it hit his hit his stomach. Anyway, So they're just bringing over the assets, showing you where they're getting them. And I think you're very good in this area here. Do you have any questions on that at all, or?
No.
Okay. Owner may make additional investments, and they'll appear as part of your equity statement. We will illustrate additional investments for Ramon's shopping service. Ramon Balboa. He was a fighter from Philadelphia, wasn't he? Ramon Balboa. Anyway, capital account had a beginning balance of 5,000. During the month, he invested another 3. The 8,000 appears in the unadjusted trial balance as total investment. So, I mean, this is just boilerplate stuff. I mean, he started off with 3, or rather with 5, and now he added 3 more to get up to 8,000. And you just have to present that in the equity statement.
Mhm.
So it makes sense, Carrie?
Yeah.
There's not much to that. Now we get into what the chapter purports to be about, which is the stuff called closing entries. We have permanent accounts and temporary accounts. Permanent accounts, temporary accounts. Permanent accounts equal the balance sheet. If you want to make that note, permanent accounts are the balance sheet. Anything on the balance sheet, we do not close. We do not close. They go on forever. At the end of the month, we have $100,000 in cash. At the end of the next month, we maybe have 200,000. It continues and continues, the balance sheet. What you do close are what are called the temporary accounts, and the temporary accounts are the income statement. Temporary accounts are the income statement and drawing. These accounts are closed, and we're going to talk about how we do this. Where are we closing them to? We're closing them into capital, right? We did the equity statement. We had the beginning capital, and then we came to the ending capital. But we haven't done it yet in the general ledger, and that's what we're talking about. We have to move that net income from the income statement into the balance sheet. So we have temporary accounts. What we're going to do, Carrie, is we're going to zero out everything.
Mm-hmm.
We're going to give temporary accounts 0 balances so that they are prepared to accumulate new information for the next accounting period.
Okay, wait.
When you look-
Okay. Can you go back just a second? So,
Sure.
So the income statement and drawings are closed, and so you go from what did you say? The general ledger.
We're going to have to write journal entries to close the temporary accounts.
Okay.
We've already done the financial statements. We wiped our brow. We got through another closing, but we do have to do one last thing, and that is close the temporary accounts.
Okay.
And you'll see how we do that here.
Okay.
The closing process, it gives temporary accounts 0 balances so that they're prepared to accumulate new information for the next accounting period.
Okay.
When you look at a general ledger, at the expense portion of your general ledger, every single expense is going to be 0 at the beginning of the month. Same thing with your revenues. Okay? Same thing with your drawing. They're all going to start off at 0.
Okay.
And this is the process. The income summary account is going to be used to aid in the closing process. Income summary account, that's a new account you're hearing about. It's a holding account, if you will. We're going to run the numbers through income summary and eventually into the retained earnings. Income summary is not an account that you'll ever see have a balance. There's no balance in that account. It's just a clearing account. And let me show you. And they're talking about 4 basic steps, and these steps are well presented here, okay? First, close your revenues. Close revenues. Revenues have credit balances, right?
Right.
So what are we going to do? We're going to debit the revenues. We're going to debit all of your revenue accounts. Now they're 0. And we're going to put the credit into income summary, all right? So you close the revenues first. Then you close the expenses. And you do that by crediting every expense. Credit, credit, credit. And then you add up those numbers and that becomes your debit to income summary.
Okay.
So at that point, what does the balance of income summary represent? It represents the net profit. So now that profit is sitting in income summary, ready to be moved over to retained earnings. The third step is close the income summary. Step one, close the revenues. Step two, close the expenses. The balance in the income summary will represent the net income. And we're going to put net income, we're going to debit income summary and credit owner's capital. All right.
Okay.
And that's the third of four steps. And the fourth step is super easy. We just close the drawing directly to the owner's capital account.
Okay.
In other words, we're going to credit drawing and debit capital. So it sounds simple, but it kind of confuses people a little bit when they're first seeing it. So let's take a look at it. Oops. Oops, 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 oops. Here's your revenues. They have a credit balance, right?
Mhm.
So we're going to debit revenue, which is what they're showing us here. We're going to debit revenue and credit income summary. Your expenses all have debit balances, so we close them with a credit, and that goes up to income summary as the expenses. So at that point, we have put the revenues and expenses into the income summary, otherwise known as the net profit.
Mhm.
And then finally, we have a credit balance in income summary, which we like to see. So we're going to debit that to zero it out. Income summary is now zero, and you credit the owner's capital.
Mhm.
Okay. You also have drawing. Drawing, you just close directly. You just credit drawings and debit the you close the drawing with the debit and credit the net income. Okay.
Mhm.
Let me look at that for 1 second. I don't like what I see. Yeah, that's right. You end up debiting owner's capital. This is just demonstrating that the income summary everything would be the opposite if it was a net loss, but I think we don't need to worry about that. Here we go. This may make it a little clearer. Look what they did with those revenues. They debited them for 8,000 and credited income summary. Get a load of those expenses. They credited every single expense. Every single expense was credited. And you total them up, and that becomes your debit to income summary. That's the 3360. And that left that famous income number of $4,640 there, which gets closed out to capital. Debit and credit capital. And then drawing, all you do is credit drawing and then debit capital up here.
Okay, wait, I'm like, okay, why are we doing this? Why are we?
Oh, you want to know why, huh? You want to know the reason? I'll give you the reason. The reason is that at the beginning of every fiscal period, our expenses have to have a zero number there, a zero balance. We have to close out everything into the capital account. If we didn't do this, the capital wouldn't change from month to month. You'd never be touching it.
Uh-huh.
The capital at the beginning of the month for this guy was $5,000, right?
Right.
If we didn't do these closing entries, that would be $5,000 forever.
Mm-hmm.
So this is the reason for this. This is the method for taking the net income and updating capital.
Got it.
That's the whole reason for it. And that's a good question. A lot of people are thinking to themselves, well, what are we doing here? What is this all about? And also in your general ledger, you don't want to see accumulated expenses mixed up with the current expenses. You just want to see a quick zero balance to begin with, and then go from there.
Okay.
So this isn't too terribly hard, as long as you understand what we're trying to do. What we're trying to do. So that was a good question. What we're trying to do is update capital. And here are your journal entries. Here are your journal entries. And I do recommend doing them this way. They're famous 4 steps. 1, close revenues first. Close your expenses next. That will leave you with the net income sitting in the income summary account, which you then can debit and credit capital. And drawings get zeroed out directly to capital. That's the easy one, okay?
Okay.
Any questions on that, Karen?
No.
Okay. Then when we're done, the final thing is we have to prepare one more trial balance, a post-closing trial balance, it's called. It's prepared after the closing entries. And again, it just proves that debits equal credits. But on the post-closing trial balance, you're only going to see the balance sheet people.
Yeah.
You notice that?
Yeah.
Yeah. So that's how we go into the new year or the new month. So 2 seconds into the new month, we made a sale. All of a sudden, we've got revenue on this thing. We paid a bill. We have expenses. Steps in the accounting cycle. I don't know about this. Hey. You know what this is here, Carrie?
What?
This is kind of the summary of what we've done. Let me just move this thing in.
So far. Yeah.
Yeah. You know, in chapter 1, they talked about source documents, and we learned how to journalize and et cetera, prepare the trial balance, do the worksheet, blah, blah, blah. Okay. Good to know all that, huh? But more importantly, each step should be recognizable to you, right?
Right.
Source documents, journalize, post. We learned how to write journal entries, post them, prepare the trial balance, you do the worksheet, and then you're ready to do your adjusting entries. Then after the adjusting entries, and only after the adjusting entries, you can do the financial statements and then the post-closing trial balance. And that's the end of this chapter. I knew this was a quick chapter.
Yeah.
That's why I was a little surprised at the beginning when they were going through current assets, current liabilities. You know what I think? The author fattened up this chapter just a little bit.
They needed to make it longer.
A little bit of filler.
Yeah.
I think there really this chapter should have been part of chapter 5. I think, but anyway. So what do you think? Are you scared of closing entries, Carrie?
I mean, I think I need to just go through it again because when you're doing the balance statement, like what we've been talking about in the examples are someone's starting a business, right? So they start with, they invest a certain amount and then they earn a certain amount and then their capital increases by the end, right?
Yep.
So doing the closing statement, you're just showing that increase, right? That's changing the capital.
Yes.
So yeah, it just seems like it's just completing that process. But I think of the beginning balance and the ending balance, don't you show that increase on the balance statement already?
Yes, it might. Yes, it's in the. You can prepare the financial statements, but you still have to close so that the capital gets updated.
Okay, so then you're kind of starting from zero again.
Yeah. When you look at any general ledger on the expense side, you're going to see a beginning balance of 0, and that's kind of what you want to see, because you don't want to see accumulated expenses for the whole year showing up there.
Right.
You want to look anew, if you will, at the income statement world. You want to start off with 0 for revenues, and only thing we want to see are the monthly transactions. The assets, liabilities, and capital are different. Those go on forever. We don't close cash at the end of the month or accounts receivable. They're just permanent entries. They go on permanent accounts. They go on into the far future.
Mhm.
Those steps in the accounting cycle. And wow, that was the end of it, huh?
Yeah.
Statement of cash flows. If you take, are you gonna take 230, Carrie?
I don't know.
Well, if you do, you're gonna get a whole chapter just on preparing
Okay.
the cash flow statement, which
But
is
230 is what is 230?
230. We used to call it intermediate accounting, I think, when I was in school. It'll the first few weeks of it will be this entire course basically,
Uh-huh.
just to get everybody up to speed. And you're gonna have an advantage now that you've gone through this.
Mhm.
So the first 4 chapters should be fairly easy for you.
Uh-huh.
Then after that, each chapter brings you into a world like chapter 6 is all about cash and accounts receivable, how companies handle the problems with cash, how you prepare entries for bad debt expense, things like that.
Mhm.
Chapter 7 is all about fixed assets, various depreciation methods that you would learn,
Sure.
how to record the disposal of a fixed asset, depletion, amortization. Then chapter 8, you get into inventory and the cost of goods sales. So it kind of just plucks something out of the balance sheet and then goes into an extended learning curve for you.
So what is the title of that course?
Financial accounting.
Financial accounting.
We,
Okay.
yeah. I notice all the schools, at least that I've checked out, they all call it financial accounting.
Okay. What other kind of accounting is there?
Well, there's what we used to call cost accounting, which is what I did for a living. That's your 240. That's management accounting.
Right.
Getting back to financial accounting, in that book, you are Nordstrom's, you are Macy's. You're
Okay.
learning all about how a merchandiser does business, okay?
Let's see. Uh-huh.
In 240, you're learning about manufacturing companies, how they track the cost of a product. Like this bottle of soda here. How many grams of plastic are needed to make this bottle? How long does it take somebody to screw the cap on? What's
Wow.
the overhead? That type of thing.
Wow.
So those that's what you got going.
Okay.
Yeah, too bad you won't get a chance to meet my friend Bill. About 3 years ago, he was then 72. Now he's 75, I guess. Bill is a guy who lost his leg, and he had to take one accounting class just to retain his real estate license. And he took financial accounting at the age of 72. And he came to me for tutoring all the time. We've become good buddies. My point is, he loved coming to the college, talking to the girls, and just basking in the college. So he's taken every accounting class we possibly.
Wow. Funny.
So right now he's taking tax accounting and some goofy thing I've never even heard of. The
Wow.
point is you're not an old person, but the point is you could do the same thing.
Okay.
Take
Always,
everything.
you should be, constantly learning. I think that's important. So.
That's true. Yeah, this kind of, I guess this keeps my brain a little bit sharper, huh?
Right. Right. Yeah, I agree.
If I wasn't teaching, I'd be sitting around doing, looking for something to do. I'd be a greeter at Walmart or something, just to have something to do. So you
Right.
okay then, Carrie?
Yeah. I'll go through this.
You
And
got any big weekend plans? You going back into nature?
this weekend, no specific plans this weekend, which is nice.
Yes, it is. Yes, it
Yeah.
is. Nice to freeform it.
Yeah.
All right. Well, I'll make a motion. We close the meeting. Okay.
Hey, I second.
Okay. And we'll see you later, Carrie. Bye bye.
Okay, thanks. Bye.
Send